Welcome to Option Trades Today. I'm Tony the Baptiste, and I've got not one, but two trade ideas for you. April 20th, 2023. Let's take a look at what the market's doing. Even the S&Ps are down 22 handles right now, but they're actually mid-priced, a lower end. You can see them getting down to 43. That's about 13 handles off of their lows, and up to 73. That's about 16 or so handles off of their highs at mid-range for the day. But we've been opening weak the last day or two and rallying back, and that's really what we're doing here today. And volatility continues to be the same story. Volatility tried to get up to 20. It's down to 1945 as a low. It's 1955 right now. Volatility continues to be crushed, which makes, if you look here on the liquid symbols, or you can make it high option volume. I went to liquid symbols to give me more products than just the high option volume list that I typically use here. And you can find all of those lists here when you go through the preloaded list. That's all that I use for all of the different products that I'm looking to trade here. There's the high option volume list, and then there's the liquid symbols. I'm using the liquid symbols just because there's more. I've taken away the earnings here and tried to sort them without earnings. And if you look here down at the IV rank right next to it, I'm looking for stocks with high implied volatility, preferably over 30, but don't have any earnings and good trading products. UVX is not one of them, being a $4 stock. So you take a look here. Gold, we already have a position in. We're slightly short gold. That happens to be working out good for us since we put that trade on, although gold is up 70 cents today. It was down $1 and change the other day. And as you go through here, you'll see that there's not a lot of stocks that we like to trade, not these $5 indexes or these $5 stocks with high implied volatility. So I have to do something that I don't usually like to do, but I did talk about on the show, trading a stock post earnings, meaning it just had earnings earlier today or last night, and now the stock has had its implied volatility really contract. Now, I did not put on a pre-earnings trade in Tesla, so I have no position on in Tesla, but I'm going to put something on today, and I'll tell you why. Because the IV rank at, let's just round down to -5, is about as low as it's ever been. As a matter of fact, it's as low as it's ever been by IV rank for the last year. Let me explain how IV rank can go negative. There are no walls to IV rank, meaning 0 and 100 are not absolutes. It can go below 0 and it can go above 100 for IV ranks. There's no fence on them, is what I really should be saying. Why? Well, what it's telling you is if Tesla was as low as it's ever been today over the last year, measuring IV rank, it would be 0. If it continues to go lower that day, the IV rank will get more negative. As a matter of fact, if the implied volatility continues to go lower in Tesla today, it'll go -6, -7, -8, and so on. Tomorrow morning, if it opens, volatility opens unchanged, the IV rank will no longer be -5, which it's showing you right now. It'll show you 0, because that's the new low in Tesla. If it continues lower tomorrow, it'll go back to a negative number. If it continues a little higher or stays the same, it'll be 0 or a +1 or +2. I hope that helps you understand IV rank and how those numbers can be negative under 0 or over 100. Let's take a look at IBM just for giggles here, because it also had earnings. You're looking at basically a 0 in IBM. So if IBM volatility continues to go lower, it will become a negative number. All right, let's take a look here. If I've got liquid symbols, if IBM is in here, if it is, it'll have a little gray mark. It doesn't. IBM is not, even though it's one of the names that everybody knows, it's not really that big of an options trade. Let's look at Tesla, TSLA. All right, when you put in Tesla here, you'll notice that it comes up, it pops up here. I'm just going to put it at the top of the screen here. And the IV rank has gone down by almost 10%. That's a good sized number, but not a giant number. Typically after earnings, IV rank will go down 15, 20, 25, 30%. But you know what? Tesla's IV rank yesterday was not very high. So not surprising that the IV rank over the last 10 days is only down 10%. You can see that there's no earnings coming for Tesla in the next couple of months because it's post-earnings. It had its earnings last night. The expected move was around $13. It's down $15 and change. As a matter of fact, it's trading at or around its low. Its low today was around $164.75. It's just off of its lows right now. So what am I going to look to do in Tesla? Well, if IV rank is low, we typically look to be directional in nature. So I have two trades for you. One is going to be directional, and the other one is going to be non-directional. All right, what am I going to do? Well, am I going to go to May with 29 days or June with 57 days? 45 days is optimal. Now, a lot of people will say, why don't you take a look at the June options with closest to 45 days? That would be 43 days that we have here. And you can see the markets are 15 to 20 cents wide, and there's not a whole lot of open interest. I'll change open interest to volume just for demonstration here. You'll see the volume is good, not great. Let's change June and take a look. Change the June weekly options and go to the June options with 57 days. Now you'll see the volume here. This is just volume, is in the thousands. Volume is what's traded today. You can see there's thousands everywhere. I'll change volume to open interest so you can compare that. And you can see the open interest is thousands on each side. Liquidity is king when you're trading, and we want to trade something that's liquid. Obviously, the stock is liquid, but let's trade the monthly options that are the most liquid. Now your decision is, do I go to May that has a lot of volume, or do I go to June? Closest to 45 days, you might default to May, but when you take into consideration that 21 days before expiration, you'll be looking to roll this from May to June, I save myself the aggravation, and with only keeping this trade on for 8 days, if I were to roll that trade, I'm going to just open June today. All right, I told you I wanted to be directional, or I think with volatility being low, you have to be directional. I'm going to take the contrarian roll, even though Tesla is making lows, and you'll be able to put on this trade better than I put on this trade. Let's take a look at what I'm looking at and Tesla. All right, since the implied volatility is so low, and I still want to sell premium because that's what I do, I can't flip the cards over, I'm going to look to do a put ratio spread. It's omnidirectional to bullish. Now, we typically like to do something like buy the 15 delta option and sell as wide as we can. So if I was going to buy the 135 put and get as wide as I can for a small credit, I would look to go $10 wide. That would be $10 wide between my long and short strikes. I'm buying one and selling two. I'm buying one 135 put and selling two 125 puts. Now this is going to have a high probability of success, a 94% pop, and I'm going to use around $4,300 in a regular margin account. The delta is positive by 3. And my theta decay, how much do I make per day to hold this trade, is about $3.70 if volatility does not expand in this trade. Now, you can go, and we do like to get very wide when implied volatility is high. I know it's low, but I'm giving you the criteria of when it's high. And we like to go about as wide as we can for ever so slightly small credit. So we could go down and get a little wider in here and get almost $12 wide on our strikes. Why does Tesla have these funky strikes? Well, it had a split when this option was still around earlier last year. All right, so $10 wide for 63-cent credit would be typically the type of trade that I would like to make, but I'm going to get directional here. I'm going to make it directional by moving in my strike and reducing my probability of profit from 93 to about 89. My delta goes from 3 to 8. I pick up about 5 deltas, and I pick up about $2 in theta decay. But look at the credit that I receive here. It's $1.83 or $1.85. Now, I placed this trade earlier, and I got $1.75 for my trade. Well, you could do that with very easily by just hitting the bid here, but I don't want you to do that. I want you to go in at mid-price or higher and walk the trade down. Now, if you're not quite as bullish as I am, you certainly could make this $10 wide. If you make this $10 wide, your break-even is all the way down to 115 plus the small credit that you received. So when was the last time Tesla was down to 115, you ask? Let's take a look. It's not as long as away as you think. It's back in January of this year. So anything can happen with this trade, even though it shows you a 95% pop. We would need that outlier move. If we move it into the 30, what am I hoping? I really want the stock to go higher today, tomorrow, quickly, because I have a little bit more delta on the trade. Now, if you're in an IRA account and you're putting on a trade like this, it might use $13,000 or $14,000. What's a good way to reduce your buying power? The same thing that I showed you on the last podcast would be to buy an out-of-the-money option. I'm just going to go to make it a round number. I'm going to go to the 80, and for 20 cents, if you were in an IRA account, again, I'm in a margin account, so it's not going to change. But if you were in an IRA account, it would go down to around 28 or $25,000. $2,500 is all you would be using instead of the $13,000. You actually be using less buying power than what's in the margin account. So you might want to check that out. How can I make this trade less directional and still sell premium, actually sell more premium? Well, do the same thing on the call side. So let's go up to around the 15-ish delta. Let's go to the 205 calls just to keep it round numbers here instead of using these other options, which you certainly can. They are a little bit wider at times. Here you can see they're actually a little bit tighter right now, but you'll notice sometimes they get a little bit wider. There's plenty of open interest in all of them. I would have no problem with any of these strikes in Tesla that you pick. But I'm going to go to the 205 call, buy one of those, and sell 2 of the 210 calls. Buy one of the 05s and sell 2 of the 210s. I'm going to have to click off of this. If it's highlighted, it will change the number of strikes, number of contracts I'm putting on here. So right now that it's highlighted right here, when I change this to number of my quantity, change it up, it's only going to move that strike. Okay, so now I can do both sides for $3.25, and you notice my buying power only went up by around $500 or so. So if you're looking at use of capital, yes, my pop went down from the high 80s to the low 80s, and my delta is no longer long, it's actually short too. My theta went up. If you're more neutral, this would be the type of trade that I would put on instead of just the put ratio spread. So what did I do for you? I put on both those trades. So we'll watch them both together. I have a double ratio spread, which is also called a Batman trade, because if you look at the risk graph of this, it looks like 2 bat ears are popping up at you, because what's your break even on this one? Well, your break even on this one is over $215 plus the $3 in credit you receive. So let's just call it $218 and change. But the max profit to the upside is $210, where you make $500. Remember, you're long one of the 205s, you're short 2 of the 210s. If the stock was at 210 or just below, those 210 options are going to be worth 0. The 205 option is going to be worth $5. The same thing to the downside. If the stock was 130, your 135 put that you long one time would be worth $5. Your 130 put would be worth nothing. That's why your break even is 125 plus the $3 and change in credit you're receiving, bringing you down to around 22 or so, which is a high probability trade of around 82%. You ask yourself, why can one side of the spread have a pop in the mid 80s to high 80s, and you're doing both sides and the pop is lower? That doesn't make sense. I'm collecting more credit. How can be the pop lower? Well, you can lose money on both sides is the reason for that. So you no longer have the advantage of the delta. You have the advantage of the higher credit received. And as the stock goes lower, the higher credit you'll be able to place this trade. All right, I put on both these trades for you because I'm that kind of guy, and I hope you're that kind of person that's going to move your account to tastytrade immediately, if not sooner, and take advantage of some of the great offers that we have there. Depending on the size of your account, I believe you can get up to $2,000 for moving your account to tastytrade, but read all the fine print and check it out. If you have any problems, you can always email me, B-A-T, at tastylive.com. That's the site that you watch for all the great quantitative finance that we put out there for free each day. And how do we keep these lights on? By you moving or bringing your account to tastytrade and checking out the best trading platform in the galaxy.